Hello, everyone, and welcome back to our accounting adventure with ACE Accounting.
Today is our lesson on understanding notes payable in accounting. In today's video, we'll dive into the world of financial transactions and explore the concept of notes payable, a fundamental aspect of accounting and business finance. Let's start by understanding the importance of liabilities in accounting. Liabilities, in simple terms, are obligations or debts that a company owes to others. They're crucial components of a company's financial health, alongside assets and equity. And among these liabilities, notes payable hold a significant place. So, what exactly are notes payable? Notes payable are essentially written promises by a business to pay a specific amount of money by a certain future date. Think of them as formal IOUs, often accompanied by an agreement to pay interest on top of the principal amount. These notes serve various purposes for businesses. They can be used to borrow money for operational needs, purchase goods or assets, or manage cash flow more effectively. A note payable typically consists of several key components that define its terms and conditions. First, there's the principal amount, which is the initial amount of money borrowed or owed. This is the core amount that needs to be repaid. Next, we have the interest rate, which represents the cost of borrowing the money. It's expressed as a percentage and determines the additional amount paid on top of the principal as interest. Then there's the maturity date, which is the date by which the borrower must repay the principal amount along with any accrued interest. Lastly, there are the parties involved. In a note payable, there's the borrower, who owes the money, and the lender, who is the entity or individual lending the money. These components collectively define the terms of the note payable, outlining when the money must be repaid and at what cost. Let's break this down with an example. Imagine Porter Company borrowed $10,000 from the bank on November 1st. They have to pay it back in 6 months with an annual interest rate of 6%. So by May 1st, they need to return the $10,000 they borrowed plus an extra $300 in interest, calculated as $10,000 multiplied by 0.06, which is the interest rate, multiplied by 6 months divided by 12 months in a year. To document this loan, the bank will ask Porter Company to create a note payable.
So, when you hear notes payable, just think of it as a formal way for companies to say, "Yep, we borrowed some money, and we promised to pay it back by this date." It's all about keeping track of who owes what to whom in the big world of money. That's it. I hope you learned something today and come back for more educational accounting videos.